Okay, guys, Monday, the 30th of October, and welcome to the weekly look ahead, brought to you a little later than usual here. But of course, we have Halloween this weekend, and if you're not in the know, we did actually invent Halloween here in Ireland. Jack O' Lantern, go and look it up. It's a bank holiday here, of course, and pretty much nowhere else. So, hence, I'm just coming a bit late to the weekly look ahead. Yeah, and so oil moving to the downside here, but we'll get onto that in a second and have a look at what's been going down. But right now we're going to have a look at the calendar ahead for the week, and it's a busy one apart from today and tomorrow. So, looking here, nothing today. Tuesday, tomorrow, CPI's out of Europe, consumer confidence out of the US set to come in 100, prior 103. Not that interesting. Then we got into Wednesday and the big stuff starts happening. Of course, we got ADP. The clocks have changed here, so be aware of that. We got ADP, we got Jolt set to come in 9.2, below prior 9.6. We got crude oil, but the big one is the FOMC statement, which of course will be trading live in the Duggan Capital Discord. So please do join us in there if you can. Anyone looking to get a sign up discount to the Discord room, just send me an email, tim@duggancapital.com, and especially to the members of Jason's room, the CMR room. But listen, we're going to be on at 5:45. We're always on 15 minutes before the rate decision drops. And then we cover all the way all of that price action. We have a little chit chat about what we're expecting on the markets and looking at specific prices on specific markets. And then we go all the way through live through the press conference, which starts about 30 minutes later, and Jerome's Q&A. And then we kind of cut after about half an hour after the press conference starts. Want to get through this. Jobless claims Thursday, and then of course Friday. Non-farm payrolls, looking for a consensus 188,000 on the street, prior 336 on the beat on the prior one there. So I want to get over to the charts pretty quickly here because we do have some dip buying coming in on oil here from, what is it, about 4% down. Yeah, so the week really starts on Wednesday, and the jolts there at 2 o'clock pre-market, 30 minutes pre-market because of this clock change. Yeah, that's the calendar. I want to get to a couple of news items here. So obviously, the market is looking for a pause. The Fed funds rate, or the Fed funds tool, FOMC tracker tool on the CME here, as you can see, has it priced in that we will pause at 5.25 to 5.5, 98.2% probability of a pause, 1.8% looking for a cut. And I just don't see that happening. I don't think we've sold down enough in equities for that to be happening right now. So yeah, let's kind of keep that in mind, right? So what else am we looking at here? Yeah, so as we move forward, something big that's kind of pushed oil down a little bit here is the World Bank has been coming out today commenting on what the Middle Eastern situation is going to do to the price of oil, and a couple of different scenarios coming into play here. But namely it's worth reading through this article because they have a couple of different scenarios, and there is just so many different sort of items that are pushing and pulling oil around the place, not just the Middle Eastern conflict. The main big one here is that as of Friday, it kind of came out. I'm going to cover it here, actually. It's Javier Blas actually covered this in a tweet, came in on Friday saying not only Iran is boosting its production, but it's also liquidated its massive holding of floating oil storage. So essentially, because Iran has had US sanctions on its sales of oil and production levels of oil and all this sort, they've been selling it in the background on the sly, shipping it away in tankers that have their trackers turned off. All right, now the gloves are off, and they're just saying, you know what, we're not hiding it anymore. We're just boosting our production, and we're going to keep selling this stuff to anyone who's going to buy it. Now, that's the biggest threat to the supply and production and supply and demand picture in oil right now. Why is that? It's because Iran are going to flood the market here with as much as they can. Okay, and that's why we're coming off here on oil today. All right, and we're going to look at the charts. I posted this at 9:30 a.m. on Saturday morning in the Dublin Capital Discord room, and I said this is why we are going to gap down on the reopen on Sunday. And sure enough, we did. We can go over and have a look at that on the chart here. If I just kind of transition over, you'll see there's crude oil on the daily chart. And here we look at crude oil today, 30-minute bars. This was the gap down just in here, down to here. So if I just kind of turn this on again, it was what? Closed at about 85.46s, reopened at 84.58. So almost about $1 basically on a gap down. And here we are down here. Close this old gap here that we were looking to trade. I'm looking for this thing, maybe not in this session, but over the course of this week, we are going to trade 80.96s and potentially below. But you can see I have a big highlight here to buy around this level, and so that is interesting. We are going to be looking to get ourselves organized on the spread here once we move down, but we're looking to be long this thing really from just early to mid-December, and we're going to be trading on the January contract rather than trying to buy into the falling knife on the deck contract, which is what we have here, right? So anyway, that's oil. Getting back to a couple of these news items I wanted to look at, the situation in Israel and the Middle East. Look, I'm not going to try to keep up with the rate of change here on this situation. That is not my job. I am really here to show you the contextual areas that these markets are going to move in, or that I think they're going to move in, and what are most likely levels to start trading, on certain products, and where do I think we're going. Essentially, I'm not a newscaster, and I'm sure you guys are happy that I'm not going to try and do that either. Okay, but nonetheless, the last video I went live last week because the Washington Post, I think it was the New York Times, was it one of those anyway? I quoted it in the video. Came out and said that the invasion of Gaza was delayed, and instantly we got that. When that article was released, we got that in the squawk pretty much as it happened, as it got released, and instantly you saw an offer come in on oil, and then it got rebid. So we came down, we tagged that like 83s level, and then we just instantly got kind of bid 82.60s, and then just instantly got bid again. Because people coming into the weekend didn't want to be kind of holding net short on oil, right? Over a Middle Eastern conflict. Listen, it just kind of doesn't make sense. And so there was that tentative bid there protecting like 82.40s. But that's gone now. That's gone. 83.60s down to 82.40s. It's gone. And now those guys just basically got handed a sick bag, all right? Because Iran is producing at increased levels here. Okay, so that's why we are going to be selling down here. And the more we hear about that, the more it's just going to get priced into the market. So really, I think we can sell down on front month until probably the 10th of December. And that's when people start, there'll be a lot more volume trading January as the front month contract. And there is a seasonal lift that comes in there. Anyway. Moving on. Yeah, I was just kind of dicking around on Twitter, and over the weekend I saw this chart about credit card delinquencies, and I was like, what? We're at 50% credit card delinquencies. Look, these guys, Game of Trades, they have 152,000 followers, right? And I just thought, this guy's saying year-on-year chart is a crime, rising fast. The data here is not so. This is not so. Highest level since 1991. Here is from the Fred website itself, right? Where we have, these guys are quoting that the Federal Reserve Board is their source. This is the actual source. St. Louis Fed credit card delinquency is at currently, as of Q2 2023, at 2.77. I don't think we're at 50% credit card delinquencies. All right. So I'm just kind of pointing this out because you have to be really careful about, where you're getting your data, who you're following, and what they're saying, man. You have to be really careful. All right. Another thing that Jason was tweeting about as well was the front of Barron's this weekend. And it's time to stop crying about bonds and buy them instead. Now, maybe this will be the point where people start buying into bonds. We're going to look at that chart in a second, the US 10-year. But the point here being is that what changed since Jason and I were last talking, we were saying that these bonds are going to keep going to the downside, is that literally like not even an hour after we got off recording, it came across the tweet, the squawk there, our news squawk, that Bill Ackman had gotten out of his short position on the 30-year, and the markets kind of went a bit apeshit for a minute. So I think because he's out, maybe the dynamic will have changed a little bit, but I think this is going to be incredibly volatile until we know we know where the FOMC is at come Wednesday night. Probability obviously baked in 98.5% or whatever that they're going to pause. But as traders, right, you really get paid out when something is so priced into the market to happen and then it doesn't happen, right? And if you can have a gameplay strategy to deploy of, to say you want to, I don't know, say if they hike, right? If they pause, I think the bonds are going to go bid. I think we're going to go up. The yields will get crushed a little bit, right? But if they hike 25 basis points, which is only like priced in at 1.8% probability, if they hike, right, the bonds are going to get crushed. Now, the US 10-year is going to get crushed. Maybe you want to take like a proxy trade looking for a short on the German 10-year because maybe Tino to be super volatile, too volatile. Maybe you want to play it over a currency. Maybe you want to, maybe not on the Dixie itself, but maybe on like, the Aussie to the dollar or the Kiwi to the dollar or Euro USD for sure. You can really get a phenomenal trade-off when the market is so priced one way and the opposite happens, right? And so it's kind of scenarios like this. Now, I'm not saying that they are going to hike. I'm just saying that you can make some sweet money if you can have a gameplay situation ready to go if they do something that's out of the ordinary. Okay, and then finishing up on these news stories here. Just wanted to, I don't know, maybe I'm the only one who cares or gives a shit. Well, certainly not, but US budget gap soaring 1.7, soars to 1.7 trillion, largest outside of COVID era. So just to kind of note here that the deficit, i.e., what's left after you take in you spend what you need to spend and then you balance what you have coming in. All right, the gap there is negative 1.7 trillion. So, if the US was a business, they should be bankrupt. Okay. Now, it did go as high, I think it's 2.78 trillion in 2021 in the wash of COVID. But, it's just marking here now that we're really pushing the debt levels super high. Now, why am I talking about this? Well, I just really wanted to note that, they want to give 100 billion to Israel and 65 billion to Ukraine. And yet, this just says to me someone's going crazy, with the credit card, and so they need to be reined in and they need to be told this shit can't keep going. You are spending. We had a politician here called Charles Haughey in the 80s who was a bit of a character, bit of a crooked character, but there was a very famous speech he gave where he said we are living well beyond our means to the country when we were kind of running a deficit in Ireland. But the US is living well beyond its means. Now, do you think they can afford to send the boys and their boots onto the ground in the Middle East? I don't think so. I don't think they can afford the war. I think they need the bonds to go bid so it can crush the yield on the coupons so that they don't have to repay so much to the bondholders. I think that's what they need. But that might not happen. That probably won't happen. Well, it probably won't happen to the degree that they need it to. But either which way, is this a tradable? What's the trade, Tim? Is this tradable? It's not really tradable. I mean, you could be looking at longs for the bonds, and we'll go over now and have a look at the US 10 year. You could be looking at that trade. Here's the US 10 year here. We'll just drop this one. Here's the US 10 year. Now, weekly bars, right? We come down to the support trend, and hey, guess what? Easy peasy. Bill is out of his 30 years, and I think we're getting into a sideways Wyckoff type of consolidation here on this trend, and then we could probably, over the next 10 to 15 trading sessions, work our way back out of here, okay, on a higher risk global war event, basically, and pretty much for the reason that Bill is getting out, that people are just going to flood into government bonds if we have like a global war situation come in, i.e., World War III proper. That's one reason to not stay in the shorts on the bonds, but to be kind of, you can pile in here now. I would say, as a longer term investor or pension, look, I'm not licensed to offer you investment or trading advice. Personally speaking, if I was looking at my pension and I wanted some US 10 year in there, I would like these yields where they are right now. And we might not see these if we get a risk situation rising, we might not see these 5% yields on the 10 year for some time to come. Probably going to check in if we can with Jason this week on that one. But okay, look, that's T notes, all right. No one ever made friends trading bonds. I tell you that for nothing. Let's look at equities, all right. Well, first of all, let's look at oil. Actually, we'll look at oil first. Here we are, oil on the daily. Yeah, so there's 82s trading, right? Last time we were kind of sitting pretty around here was the 11th of April this year, just here, all right. And we'll zoom out a wee bit because I'm looking for 80.96s to trade. And I think I don't want, I really, all I can see is that we sell down and we hit 80.96s. We might flummox along here until kind of mid-November, and then maybe take a bit out of here and get up over this compression area. That's really as far as I'm kind of able to see right now, that I want to look at right now. And so 80.96s, beware of buyers down there, okay, on oil. I think we were looking for, yeah, I think I was looking for 82s last week. That worked out really nicely. Calls on the NASDAQ. We'll look at the NASDAQ right now. Yeah, look, target hit 14,186. Target achieved. Bullseye. So loving that one. And guys in the room here, I think, are on longs on NASDAQ looking for the hold. I think we can at least get back. This we're going to close this gap here, NASDAQ 14,502s. And then I think we can at least get back to 14,633s. Listen, 14,186s to the 14,633s. That's like $8,000 per single contract traded. You're doing about 26 to 1 on about 60 or 70 ticks of risk there. That's a nice trade, right? And I think we're going to hit that probably by Wednesday. Yeah, Wednesday. If they do a pause, I think the market might bid that. I don't know. It's just that the hot data, like 4.9% on the GDP in the US last week, really, the markets did not like that. That's really what started this bog slide to the downside here. So look, SPOOs, we're easily going to come back and fill this gap that we have open here at 42.11s. Now, I think I'm not sure. Last week, I'm pretty certain I was calling for at least 42.08s on S&P 500 last week, and so we've hit that. The 41.21s, I'm pretty sure I referenced that level. But obviously, tell me in the comments if you think I didn't. But I think we could do 4,000, guys. I think we could. Here's that level, the 42.08s, right? It's kind of this high here of the 14th of November last year. It's the high here of the 5th of March this year. It's all these lows here. Look at that, all these lows. Excess all around there. So it's really a demand area, that 42.08s. So if we come up here and we can kind of camp out there and we're not getting excess into that, right? You're just going to see that demand cycle come back in the same way it did here, right? But demand becomes supply, and so that's why this could be resistance, and we're going to have to actually mark this as red now, 4208 spot 75. This doesn't really look like a good turn pattern, candlestick pattern down the bottom here either. So, yeah, I think you really want to know what I think? I think we need to trade 39.12s, 39.12s, and then we can bring in the buyers, right? Look at the trend break we have as well that just occurred up here over the last week, actually 2 weeks ago. So really nice stuff, and I'm sorry, but equities are goosed, man. I don't like them here. What else? Gold, 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 gold. How's gold doing here? Let's have a look. Yeah, big trend up here on gold. It's looking, it should take a bit. It's just, if the real yields start to get crushed, right? As in the bonds, if the bond, here's the play for gold, guys. Here's the play for gold, right? For whatever reason, but it's probably going to be a geopolitical increased risk, World War III, really proper, Iran getting involved big time. If they get involved, the bonds are going to go bid. And then the real yield and the yield, obviously on the 10-year and across the strip, the back of the strip, the back of the curve will get crushed. And and if the real yield gets crushed, gold is going to rally like nothing else. It's competing with the real yield all the time. It moves inversely to the real yield. So that's the trade. And you got to wait for, you got to wait for your FOMC. You got to wait for your NFPs to really get into that. Buying that pullback, 1985s. I like it. 1985's long. Can we get that over FOMC? Can we get that over NFP? Does the Pope wear a hat? Absolutely. We could get that over any of that. Absolutely. So I like it. I like gold at the moment, and I haven't said that for what feels like 2 years. So yeah, what else? What else? What else? I think that's kind of it. VIX, yeah, look, we are in a big VIX environment here, guys. All right. I'm just gonna kind of make this really clear if I can. And we're trading about just around the 20s here. All right. I think we could easily kind of hold around 1942s. For now, I really don't see why we would go sub 19s on VIX, like in this risk environment. I really don't. So I'd say we can baseline around 1940s and then rally to 24s. But if this thing gets a insane bid into it, it could be at like 35s before you could even blink. And so that's kind of how she works on the VIX. Obviously dropping now with equities taking a bid back up here. So yeah, look, that's all I got for you. That's all I got for you for this week. So if anyone does want to join us for like FOMC, like live in the room, or just catch up with us and be part of the Duggan Capital Discord, please do send me an email to tim@duggancapital.com and we could sort you out with a discount. And obviously, if anyone's a member in Jason's room, you guys also get a 50% discount there as well. All right, listen, thanks for tuning in. Be careful out there. Wednesday and Friday are the biggies here, guys. Be careful. Oil is not going to take the bid you think it's going to take. All right. So trade easy. Best of luck. Cheers.